the auto and pharmaceutical sectors. If you're confused about what's being hit and what isn't, you're not alone. That seems to change hour to hour. Let's get clarity, though, from Tony Stillo. He's with Oxford Economics and joins us to talk about this. Tony, thanks for your time.
My pleasure to be here.
So steel and aluminum tariffs are in place, courtesy of Washington. What do you think will be hit in April?
That is a big question, and there's a lot of uncertainty, as you just mentioned. What we're anticipating is that he will proceed with 25% tariffs across the board, 10% on energy, but we expect that he'll see the light and the implications of tariffing autos. We expect the transportation equipment sector to be exempt. We also don't think tariffs on lumber will last long because it's going to hurt the U.S. economy quite a bit. So those we expect to be phased out quickly. That being said, it is definitely an open question what he'll actually do on April 2nd.
Okay, we also have, of course, canola and seafood tariffs from China. Have you been trying to factor that in as well?
Oh, yes, it is getting beyond the U.S. and they will have negative impacts on the economy. That is for certain.
Okay, so when you are forward planning and trying to do a forecast, are you planning for one scenario? Or are you planning out on multiple scenarios? How are you doing that?
We basically have a baseline, what we think is most likely, but we do look at alternative scenarios. Just like during the pandemic, it's highly uncertain environment, very fluid. And I think for anybody's planning, businesses, governments, individuals, you can have contingencies, what might be the alternative outcomes. So we look at scenarios where there'll be much stiffer sweeping tariffs, or maybe they'll be scaled back. And so we do look at alternative scenarios, absolutely.
Okay. So we've seen the markets react, right? We've seen the markets do a bit of a deep dive late January, mid-February. I'm wondering when you think we're going to see the economy really start to drag, if that's what you're predicting.
We think there's already a bit of a drag from the uncertainty. You've seen businesses curtail hiring, their capital expenditure plans have been, a lot of them on hold, and you've seen the housing market take quite a hit in terms of buyers retrenching, pulling back, and sellers listing their homes, some of them in desperation. But I think the implication that you'll start seeing the economy will happen largely in the second quarter. We anticipate there'll be job losses, there'll be reduction in exports, capex will be reduced, and you'll start to see the impact on the economy, we think, in the second quarter beginning then.
So, Tony, I know you have looked at some specific numbers and tossed them about. When you look at growth specifically for the economy, what are you looking at?
Well, we look at growth this year because we had such a strong finish to 2024 and the first part of this year. A lot of it was preemptive moves by U.S. importers bringing in more Canadian exports to their country, imports from Canada. So it boosted our exports. So the first quarter looks okay. There's some cracks there. But for the year as a whole, on average, we're looking for 1% growth. That being said, that's an average for the year. We're looking for the economy to start contracting in the second quarter through the rest of this year and into early next year. And that's about a 1% peak to trough decline. So that happens in those 4-5 quarters. And then on average this year, like I said, 1% growth. Next year, 0 growth. Okay. Even if we start to pick up next year, later in the year, you're going to get a flat economy next year.
Okay, so when you're talking about the slowing growth already beginning sort of the latter half of the year, what does that look like? What other numbers are you putting into that?
Oh, we're thinking that we could see upwards of 180,000 job losses. The unemployment rate could reach a peak of, over 7.5%. There's a cross current that's going on in the labor market. It could have been worse, but we're seeing the population. Remember, there's a move by Canada to curb immigration flows and temporary residents. So that's going to restrict the labor supply. Otherwise, it would have gone even higher. We're seeing we'll see the unemployment rate rise. Prices are going to rise. We expected before the announcement by the federal government that they will reduce the carbon tax to 0. We were expecting inflation to hit, well over 3.5% year on year later this year. The carbon tax removal takes about 0.5 point off of that, so it'll be over 3% on inflation. So that's an example of a few of the numbers that you should be on the lookout for.
Okay, so you're talking about slower growth, but you're not talking about a recession yet?
Yes, we are. It's a recession. I mentioned we think it'll start in the second quarter, last for about 4 quarters, and a peak to trough decline in the economy of about 1%.
Okay. Let's talk about the Bank of Canada for a moment, because we've had some guidance from them, but the guidance is really them saying we can't give you a lot of guidance because there's uncertainty and there are too many things at play, and we don't want to react in a way that's going to have a negative effect, so we have to wait to react. What do you, given sort of your forecast and your scenario, expect from the Bank of Canada in the latter half of the year?
Well, we're expecting them to hold, be very pragmatic. They are in a bind. They can't tackle, and they've said this quite clearly, both the inflationary impact of higher prices from tariffs, a lower dollar, and at the same time, the negative impacts on the economy. They're looking for fiscal policy to take the heavy hand in that regard. So I think they're going to be very pragmatic. We've got the bank policy rate at 2.75%. That is a neutral range for the rate as we see it. The bank, it's at the midpoint of their range. We think the bank will hold and kind of play it one meeting at a time, but they could cut another couple of points, like 50 points, to go to the bottom end of their range of what they consider to be neutral for the economy. We think that they don't want to go too much into stimulative territory. There is a concern that we could get supply chain disruptions, and we have a lower dollar, and we have the higher tariffs that could see inflation rear its ugly head again, just like it did post-pandemic. And I think the bank is playing it quite cautiously in that regard for that reason.
Since much of what you're looking at depends on what happens or what gets announced on April 2nd, I'm wondering what it would take to avoid a recession. I think you said you're based on sort of a 25% across the board. Automotive sector, transportation would be the carve out or wouldn't be touched. And you said lumber, if it was there, wouldn't last a long time. What would it take to avoid a recession?
Well, I think even if we stuck with what we've seen to date, and don't forget, it's not just the U.S. tariffs, it's the counter tariffs Canada is putting in, which we have seen two tranches of it, a $30 billion first shot, and then I'll just say, call it $29.8 billion second wave that were basically dollar for dollar retaliation for the U.S. steel and aluminum tariffs. If we see those and only those, it'll dampen growth and raise prices and costs a bit, but not a recession. If we start to see those across the board tariff hikes, and then Canada's threatened to retaliate, maybe not dollar for dollar, but significantly so, I think that'll push us over the edge into a recession.
Tony Stillo, sir, great to have you. Tony's the Director of Canada Economics at Oxford Economics. Thanks for your time.